Welcome to The Explainer. Today, we're diving into a complete masterclass on architecting the 2026 Financial Freedom Blueprint. We're going to be translating what are usually overly complex financial strategies into a really clear professional-grade roadmap. Look, if you've ever felt like you're doing everything right but still somehow falling behind, or that outdated advice is holding you back, you're in exactly the right place. Let's kick things off with a quick what-if scenario. What is the real cost of inaction? Well, on one side, you've got the passive saver, hiding cash, hoping to build a safety net, but inadvertently losing massive value to the silent erosion of inflation. And on the flip side, the blueprint investor. They aren't just saving, they are dynamically protecting their capital and actively scaling their wealth. Okay, so here's our roadmap for today. 1. The 2026 Financial Reset. 2. Dynamic value-based budgeting. 3. The psychology of wealth. 4. Technical analysis demystified. And finally, 5. Our 2026 wealth building roadmap. Let's jump right in. Section 1. The 2026 Financial Reset. Why traditional strategies are actually failing. We've got to start with a bit of a harsh reality check. Hiding your money under the mattress or parking it in a basic savings account is a losing game. Those save all your cash strategies are actively failing, and it's all because of the silent erosion of inflation. It's kind of like a slow leak in a tire, right? The numbers in your account might look exactly the same, but the actual buying power of those dollars is just quietly deflating day by day. Moving to Section 2, Dynamic Value-Based Budgeting, ditching the outdated 50-30-20 rule. I mean, you've definitely heard of the 50-30-20 rule, right? 50% to needs, 30% to wants, 20% to savings. Well, guess what? It is completely outdated. It's way too rigid, and honestly, it ignores the reality of modern monthly market volatility. You just can't apply a static, rigid percentage to a dynamic environment and expect to scale wealth. Instead, we need to talk about dynamic value-based allocation. This is a real game changer. It adjusts every single month based on market volatility. You set a strict categorization of your fixed needs, stripping away all the fluff, and then you put a heavy allocation straight into high-growth capital reserves. By totally replacing those rigid percentage rules, you let your capital work exactly where it needs to. All right, Section 3, the psychology of wealth, emotional regulation over raw intelligence. So let's talk about loss aversion. In behavioral finance, this is the concept that the psychological pain of losing money is significantly more powerful than the pleasure of gaining it. Seriously, finding $20 feels pretty good, but losing $20 can ruin your whole afternoon. And in investing, this traps so many smart people into making terrible, fear-based decisions. Now pair that fear with herd mentality, which is the psychological tendency to just blindly follow the actions of the majority. Everyone is buying, so you feel FOMO and buy. Everyone's panicking, so you sell. It leads to incredibly impulsive market timing. When you look at it this way, it's clear. The absolute best investors aren't necessarily the smartest ones, they're just the ones who can regulate their emotions. So how do we actually fix this? You follow a few simple steps to save you from yourself. First, define strict investment goals. Second, implement automated investment rules. Third, this removes daily decision fatigue. You don't have to guess if today is a good day to invest. And 4, it systematically prevents that impulsive, emotion-driven market timing. Automation is literally your shield. Which brings us to Section 4, Technical Analysis Demystified. Confirming trends like a professional. I know reading stock charts can sound overwhelming, but professionals use specific indicators to confirm trends instead of relying on their gut. Let's look at 3 core ones. Moving averages, they're used to confirm the overall direction of a market trend. Then you've got RSI, or Relative Strength Index, which identifies if an asset is overbought or oversold based on momentum. And finally, volume. Volume acts as the ultimate confirmation of a trend's true strength. If the price goes up, but volume is low, professionals know something's off. Now check out this quote. It's a really powerful insight. Excessive diversification often leads to portfolio dilution rather than true protection. You hear the advice to diversify all the time, right? But honestly, spreading your capital too thin across tons of mediocre assets doesn't actually protect you. It just dilutes your growth. Strategic allocation absolutely beats blind diversification. Okay, Section 5, the 2026 Wealth Building Roadmap, your tactical quarterly execution. Here is how this plays out tactically over the year. Q1 is all about foundational safety, fully funding emergency funds, and eliminating debt.
Moving into Q2, it's system setup, getting those automated investment rules locked in to remove your emotions. Q3 is strategy implementation, where you start applying that basic technical analysis we talked about. And finally, Q4. This is aggressive portfolio growth, using AI-assisted research and diversified assets.
So, what does this all mean for you? Will you remain a passive saver, slowly losing to inflation? Or will you execute this blueprint and master long-term compounding? The choice is entirely yours. Make sure to download the blueprint template, subscribe so you don't miss our upcoming tech sector deep dive, and start taking control. Thanks for hanging out with me on this explainer.